Hi everyone, thank you so much for joining our first Carbon Count Unlocking Value Through Reporting webinar. We are delighted to have you here. A big welcome and thank you for coming. We know the world of carbon can seem quite daunting, and the aim of this webinar is really for us to clear that up for you, to help you feel more confident and hopefully motivated to start tracking and reducing your carbon footprint, which is what it's all about. So I'll do the intros to begin with. So hello, I'm Amy. I am PEM's ESG and community lead. I look after how we support the local community of Cambridgeshire, as well as kind of the wider ecosystem around us. Ian is the Assistant Director in our Virtual Finance office. Ian started his career in 2001 at HMRC in Cambridge. In 2007, he moved to a local accounts practice and completed his ACCA exams in 2010. He then went on to become manager at a larger accountancy firm before joining PEM in 2021 as Assistant Director of the VFO. So Ian's role involves supporting clients across multiple business sectors and delivering a full outsourced accountancy service, including managing the team who deliver our carbon accounting service. I'd also love to introduce Prad. So Prad is the UK lead at Someday. His background is in accounting and technology, and he now works with accounting firms and businesses across the UK to help them make the shift into credible, audit-ready carbon reporting. So before joining Someday, Prad worked at Xero in Australia, and that experience means he's best placed to give a unique perspective on how technology can simplify complex reporting and drive real change in the accounting industry. So I'll just pop over to the agenda. So this is what the webinar will look like. And at the end of this, we hope you understand a bit better what carbon accounting is. For some of you, this will be the first time you've really looked into it. So well done for being curious. That's the first step. And for some of you, you may be a bit more aware about it. So hopefully bringing everyone up to the same page. You can submit questions via Q&A, the Q&A function at any time, and we will get round to those in the last 15 minutes of the webinar. Awesome, let's get going. So I'm going to talk to you a little bit about PEM's ESG. So as a firm, we know and love Cambridgeshire. It's the place we're proud to call home. We're in a fortunate enough position to be able to make a positive impact on our people, the local community and the planet as well. And we've been doing that in Cambridge for 150 years. We've just celebrated our anniversary this year. There's many ways that we look after, do our ESG, and that's through the charitable trust, volunteer days, donations, excuse me, such as room hire and laptops, and environmental initiatives. So I'm super proud to share some things recently that we've done as a firm. We know that our work will inevitably have impact on the environment, so trying to do our bit to manage that impact. So choosing local eco-friendly suppliers, removing disposable cups, LED lighting, changing our coffee machines, anything we can do to have less impact on the environment. Our own carbon journey, we are going through this process ourselves. We're calculating our carbon footprint, identifying our biggest contributors. So for us, we know that's scope 3. And now, if you don't know what that means, don't worry, Prad is going to talk you through that and hold your hand. But basically, we know that our commuting and our purchased goods and services are our biggest carbon emitter. So we're looking at ways to reduce that, such as a car sharing notice board, amongst many other initiatives. At the moment, now that we've done our carbon analysis, we've got 2 years worth of data. So we are in a great position to be able to make a commitment of a reduction and set that target as part of our 2030 strategy. Without doing this process, we wouldn't have that knowledge and be able to see where our biggest carbon emissions come from. So it's been really valuable, and we are delighted to now be offering this as a service to support other firms and organisations on their journey as well. So I will hand over to Prad, who's going to talk about carbon accounting.
Lovely. Thank you, Amy. Pleasure to be here. Thanks, everyone, for coming along to the session, and thanks, PM, for putting this together. So I think I'll take control of the slides now, so that way you'll be able to follow along as I go through some of the slides that really just touch on the basics of what carbon accounting is. I think it's fair to say it is a very new concept and piece of work for most businesses, especially small businesses. So it always pays to rewind right to the start and talk about what it even means. So with that being said, I really just want to talk a little bit about and show, in fact, how you calculate your carbon emissions when we talk about carbon accounting, because it is very akin to regular accounting that we all know and love. And carbon accounting is essentially just, instead of measuring the financial dollars, we're measuring the emissions that a business has generated over a period of time. And we do that in what we call the carbon ledger, which is, again, very similar to the general ledger. So you'll notice through me talking about carbon accounting, there's a lot of parallels you can draw between financial accounting and carbon accounting. And within carbon accounting, we have global standards that we report into or report to, similar to, again, financial accounting. In carbon accounting, it's almost, we call it the Carbon Accounting Bible, which is a greenhouse gas protocol. That is really the global standard that provides really in-depth guidance on how to do this accurately and how to do this properly. And within the greenhouse gas protocol, there are three scopes of three different types of emissions that you business accounts for. Now, you might have heard some of these terminologies before. So scope 1 really, in essence, is the fuel combustion, either on-site or through travel. So you can think about, especially if you're a heavy industry, any coal burned on site, or if you've got a fleet of vehicles that the company owns, the fuel you put into that'll be strong examples of your scope 1 emissions. Scope 2 is generally electricity. So within your office, a really good example is the electricity that you pay for to run the office and run the lights and things like that. And scope 3 is generally the one that has the biggest footprint for pretty much every business. It's what we call supply chain emissions. So it's your purchased goods and your purchased services. It also includes things like business travel. So if you're catching flights for work, that all encompasses scope 3. And generally, it's the one that's the hardest to grapple with, because when you're dealing with scope 3 emissions and supply chain emissions, for you to work out your own carbon footprint as a business really accurately, you also need to know what your suppliers' emissions are. So that is something as a society we're all kind of trying to get better and better at. And the more and more businesses, especially small businesses, do their carbon accounting, the better quality data we'll have out there for other businesses to use within their own carbon accounting. It's kind of that flywheel effect. So how do you actually work out the emissions at a really practical basic level? Well, we call it basically maths with zero data. Now, I recognize not all of you might necessarily be using Xero to run your business. You might be using Sage or another small business accounting software. But really, it's the same in the sense that within that accounting software that you do use, you'll have all of your transactional data. You'll have your bills and invoices. Within those bills and invoices, there will be consumption amounts as well. Think within your last electricity invoice for your business usually tells you how many kilowatts you expended during that period of time. So those inputs or source data all exist within your accounting file like Xero. For carbon accounting, we're taking some of that data, so not all of them. We're not taking wages, we're not taking liability accounts, but we're taking the accounts that actually have carbon emission implications to them. So expenses, generally, all those expense accounts will generally have a carbon emission associated to it, and we're multiplying that by what we call an emission factor. It's a really important concept in the world of carbon accounting. Emission factors, they're really location specific and sometimes even industry and sector specific databases of averages. And you're using those averages to multiply against either the spend data, so call it £200 on electricity for last month, and that will give you the emissions expressed as tons of CO2. Now, a couple of things on just a real quick note on why emission factors are so important. And I'll give you a practical example that will make it make more sense if you've never heard of this concept before. In the UK, as an example, the UK government actually has an emission factor database that they provide every other year. called BEIS. And within that, it'll have location-specific emission factors for a kilowatt of energy, or electricity rather. And that will be location-specific, and that will have a number associated to it, and you multiply that number against the kilowatts that your business actually used in a period of time. So that's easy. Then you get your emissions. Now, that emission factor for 1 kilowatt of energy in Australia will look very different. Australia generally is powered by, is still a lot powered by coal on the grid. And so you can imagine that's going to have a lot more emissions associated to it. And so the average emission factor for 1 kilowatt of electricity in Australia is going to be a lot higher. And so choosing the right emission factor and the most relevant one is important because it reflects the accuracy of your carbon accounting. Now, demand is growing, and it's growing really fast within the carbon accounting and climate reporting landscape. And it's definitely growing for quite a few different reasons. I'm going to touch on some of the regulatory aspects, especially here in the UK, that is growing this demand and making more and more businesses sit up and think, oh, geez, we should be doing something here. We need to be thinking about this. And then Ian is going to touch on some of the commercial strategic reasons you want to be thinking about this, especially if you're a small business. You might not necessarily be mandated to do it, but there are some really strong reasons you want to be doing it from a competitive advantage standpoint. But regardless of whether, why you're doing it, we really believe that accountants are best placed to do this work. In fact, Someday used to not be called Someday at all. We used to be an accounting firm years ago, all the way in rural Tasmania, Australia. We were an accounting firm. We did more and more carbon accounting for certain mining clients that actually needed to, or were mandated to do that. And then over time, we did the firm just basically was only doing carbon accounting for clients, and then built its own in-house software in order to do it more efficiently and more effectively, and then basically sell the firm, went all in the software. So that gives you a bit of background behind where we're from and why we think accountants are the best place to do it. Fundamentally, it's because really for two reasons. The first reason is your accountant already has a lot of that source documentation and source information that you would need to do a really reliable set of carbon accounts. That's things like what already exists in your accounting systems and your financial reports, all those source documents like invoices, receipts. Those already exist and generally are already being used by accountants to do the financial accounting. So one makes it a lot easier to just lift and shift that or take that same work into carbon accounting. But also two, and more importantly, carbon accounting is a lot like accounting in the sense that there's that transparency, robustness, there's a rigor to it, it ties back to standards. And if there's one thing we know with accountants, we love numbers, we love robustness, we love a balanced ledger. And so a lot of those same concepts exist within carbon accounting. So it's a very transferable skill, which makes it really perfect for the world of accountants and finance. So I mentioned standards across the globe are, really progressing very fast. It's moving at a rate of knots. In terms of more and more countries adopting standards, more and more industry boards releasing their own standards when it comes to climate reporting. It goes way beyond just carbon accounting as well. It goes through the ESG reporting holistically. But I think what's important to call out here is that a lot of these sustainability reporting standards, whether it's international bodies, whether it's regionalized countries, a lot of that ties back to the GHG protocol, which is really good. So what it means is globally, there is a consistently agreed upon way of doing carbon accounting. And that makes it great for, software companies like us, because it means that, you don't have to regionalize the software, but it also makes it a lot more applicable for businesses because you're not having to really tailor based on region. So at present in the UK, who must report? So you may or may not have heard of a current standard that's in place called the Streamlined Energy and Carbon Reporting, ACCR for short. That applies to listed companies in the UK, but it also applies to large unlisted companies, unquoted companies as well. As long as those particular companies, those unquoted companies, meet two of the following criteria: either their turnover is over £36 million or more, balance sheet total is over £18 million or more, or they have 250 employees or more. So as long as you meet two of those criteria, you will fall in the bucket of needing to do your SECR reporting. And generally, that means that you're going to have a lot of medium-sized businesses also being caught in this and needing to be aware about this. In terms of what you must report if you do fall under that standard, it's your scope 1 and 2 emissions. So I talked about that earlier. That's your electricity, your fuel, any coal or gas combusted for the purpose of running the business. That has to be reported. Scope 3, the supply chain piece, is currently voluntary, but it is strongly encouraged. It's strongly encouraged because no doubt this is going to expand into doing scope 3. So really, you want to be preparing ahead of time to be able to capture this data and build the muscle in terms of how to actually do this reporting. But what is also currently in draft, which is quite exciting, is the UK Sustainability Reporting Standards. Now, that's a lot more wide-ranging. It captures a lot more businesses, and it has a lot more of a robust and, I guess, intense reporting framework for businesses to follow. So that's currently in draft at the moment. It's in a consultation period. I suspect early next year it'll pass, and there'll be then basically a roadmap of when businesses need to start reporting based on their size and what they need to report as well. Australia, I'm from Australia originally. The accent hasn't given it away. And we are about 18 months ahead of where the UK is in terms of these particular reporting standards. So we've really seen the ripple effects it's caused. It's mainly the bigger businesses that are having to do it right now, scope 1, 2, and 3. But through their supply chain, they're actually reaching out to their SMB suppliers to say, hey, we need your carbon accounting data in order to do our own accurate scope 3 carbon accounting data reporting. And that is creating, again, that flywheel of more and more businesses needing to do that. So with that being said, and to talk you through those strategic reasons you want to be thinking about carbon accounting, I will pass over to Ian.
Brad. Good afternoon. Thanks for joining us, everybody. As Amy's already said, my name's Ian Gallagher. I represent the Virtual Finance Office team here at PEM, and I'm going to talk you through why carbon accounting is increasingly becoming strategically important and how it's impacting organisations of all sizes, but especially small businesses. So, starting with the bigger picture, carbon accounting is no longer optional. In fact, 70% of UK SMEs in supply chains now face requests for carbon data from larger customers. At the same time, 60% of graduate job seekers say they prefer employers with strong sustainability credentials, and businesses with robust ESG credentials see up to 25% higher staff retention rates. So in short, carbon accounting can help you win contracts, attract top talent, and stay ahead of regulations. Regulatory requirements are expanding. As Prad has already mentioned, the SECR framework means that large companies must report energy use and emissions. Government contracts over 5 million now require a carbon reduction plan. And it's not just direct regulation. 3 in 4 major UK corporates now require their suppliers to report scope 3 emissions. So whilst not necessarily mandatory yet for small businesses, early adoption will keep your business compliant and competitive. For small businesses, the impact can be direct and immediate. SMEs in supply chains are facing increasing demand to report emissions to win contracts, especially within the NHS and the public sector tender. Carbon accounting can help identify efficiencies and reduce costs. In fact, 40% of SMEs report new business wins after implementing carbon reporting. It's therefore a clear opportunity to build resilience and future-proof your business. Sustainability is now becoming a talent magnet. 60% of graduates and young professionals are seeking employers with clear sustainability commitments. Transparent carbon reporting builds trust and loyalty, whilst ESG credentials improve staff retention and engagement. So if you want to attract and keep the best people, it feels obvious that sustainability needs to be at the heart of your business. And the benefits go far beyond just compliance. Carbon accounting delivers cost savings through operational efficiency, enhances your reputation with customers, staff, and investors, and can future-proof your business against regulatory changes and market expectations. It's about building a resilient, attractive, and competitive business for the long term. So in summary, carbon accounting is more than just a compliance exercise. It can be a powerful tool for transformation. It empowers UK businesses to measure their environmental impact, manage emissions effectively, and market their sustainability credentials. So, we know what carbon accounting is and why we should do it, but why is it accounting, and why do we as accountants offer this service? Carbon accounting, as Prad's already mentioned, treats emissions data with the same financial rigour as financial data. We classify activities, collect evidence, apply controls, and ensure repeatability, just as we do with financial transactions. The Greenhouse Gas Protocol structures emissions into scopes 1, 2, and 3, which mirrors the logic of a financial ledger. This approach ensures audit readiness and assurance. And as accountants, we are trained to manage data quality, compliance, and documentation, which makes us natural stewards of carbon data. So why do accountants offer this service? Accountants already manage compliance, reporting, and assurance for financial data, and these skills translate perfectly to carbon data. As the regulatory pressures and client demand for climate disclosures expand, businesses will need trusted advisors to understand all of these new requirements. Carbon metrics are increasingly appearing in annual reports and in investor communications. So as accountants, we can ensure consistency, credibility, and integration with your existing financial systems. Here at PEM, our virtual finance office provides a fully outsourced finance function covering bookkeeping, management information, and forecasting. And as Amy mentions, we've integrated carbon accounting into our VFO team and can offer readiness assessments, monthly carbon bookkeeping, and emissions baseline reports. This means our clients gain clarity on their carbon footprint, achieve cost savings, and enhance their ESG credibility, all within a single trusted partnership with PEM. With PEM's VFO carbon accounting service, you can benefit from clarity about your carbon footprint, information to support you in the reduction of emissions and your push towards net zero, the ability to attract eco-aware customers and ESG-conscious talent, enhanced brand sustainability and reputation, and potential cost savings through more efficient carbon management. Our process is straightforward. We carry out a carbon accounting readiness assessment, which helps you identify data gaps and opportunities. We undertake carbon bookkeeping, which is monthly tracking for accuracy and efficiency. And ultimately, we provide a baseline assessment, which is a comprehensive emissions report for strategic planning. All of this is tailored to your needs and can be integrated within your finance function. So in summary, carbon accounting is more than just compliance. It's about applying the discipline of accounting to your environmental data to ensure integrity, transparency, and strategic value. Accountants, especially PEM's VFO team, are uniquely equipped to help you measure, manage, and report your emissions with confidence. So I suppose the message here is, if you're ready to take the next step, my team is here to support your journey to net zero. And if that's of interest, then please get in touch with us after the webinar, and we'd be happy to have a chat with you about that. I'm just going to hand back to Prad now, who is going to run through a carbon accounting example.
Fantastic. Thank you, Ian. I will just pull up my Someday account. So if you could just confirm that that is coming up at your end. Is that showing? Yep. I can't see. Yeah, great. Fantastic. Cool. So what we wanted to do briefly was not a product demo of Someday, but really showing you what the carbon accounting looks like in practice when it's in a software. And so I've got this demo environment set up for the purpose of showing you what an output looks like when it comes to doing your carbon accounting, because I'm very aware that for a lot of people, they haven't even seen this before. They haven't seen what a carbon accounting report could even look like. So it can certainly help to, I guess, seeing this can help visualize all of that. So we do this, and again, you're going to see a lot of similarities between, especially if you use Xero or Sage or an accounting software, you're going to see a lot of similarities between how it's set up there versus how carbon accounting is set up in something like a Someday. So you set your period, your financial year, whatever that might be. You might even do monthly or quarterly carbon accounting. So that's all possible in a system like this. And you can see here, as you do your carbon accounting, you will have the reporting, the live dashboards and things like that populate through the process, which really gives you for you as a business, it will give you an understanding of where most of your emissions sit as a business. And then you can really put focus on where to take actions in order to reduce those emissions. So more often than not, we see, as Ian mentioned, accounting firms supporting their clients to do this, because there is a lot to learn here. And like accounting, you really want to make sure you're doing it properly and robustly. And so this will be perhaps a process that your accountants will be doing when they're in your Someday organization. And it's still helpful to understand how it all comes together. And so in this case, you'll input your transactions. Your accountant will be bringing in your transactions that are relevant, so mainly the expense accounts that I mentioned earlier, into something like Someday. And then from there, they're doing most of their work in what we call a carbon ledger. So like Xero, where your bookkeeper or accountant might be reconciling transactions, and Someday they're going to be reconciling within the carbon ledger, assigning those transactions or those suppliers to the relevant emission source. And within that emission source, as you may recall, we there have the emission factor, that average that we use to multiply against. So let's do a quick example to make a bit more sense. In this case, we've got these coffee beans from a supplier called Green Coffee. This has come from the Xero organization. And here we can actually figure out what type of transaction this relates to. So again, this would be a process that Ian and the team would be doing. They're assigning the transactions to the relevant emission source. If you use different tracking categories, they're assigning that, and through that process, reconciling the transactions. Now, there is a lot of judgment that has to be had sometimes. That's a really easy example, but sometimes there's more nuances that need to be thought about in terms of the right emission source to apply, the right emission factor to use. And that's why we do recommend, leaning on your accountant to support with this, as well as obviously the initiatives that come on the back of that. And they'll also really be able to keep on top of the different emissions in each scope, overlay emission data, financial data with activity data. So a quick little tip in the world of carbon accounting, the truth is, as a society, we're all trying to move towards more and more accurate carbon accounting. For the most part, we're not there yet. And so to get more accurate carbon accounting, the baseline is just using the transactional level data and basically multiplying that against that emission factor average to work out the CO2 expressed tons of CO2. However, better quality data is where you actually have the actual usage. So instead of saying 150 quid on electricity, we can instead say it's 500 kilowatts, because getting that activity data is a lot more of an accurate way to do carbon accounting, and it means that the numbers are going to be more robust. But of course, That means you need to easily have that activity data available. For things like utilities, generally we do have that, but for perhaps things like coffee beans, we might not always be able to quite easily find the kilograms or grams of coffee beans to use. So as we get better and better at doing that, and suppliers provide that, we can get more and more accurate carbon accounting. Now, I will quickly pop out. So this screen here is where you can enter that activity data in order to, again, get more accurate carbon accounting numbers. We'll close that now. So as you can see, this is an active assessment that an accountant might be supporting their client through. But what an end dashboard can look like once you've worked out your numbers or got an idea of where your numbers sit is something like this. So this gives you a feel for what an output could look like if you do an assessment through Someday. In this case, you can see here we've got the total number of metric tons of CO2 emitted, and it also gives you some stats on the equivalents in relation to a household's emissions, and we can see a breakdown of where the emissions come from, which is really important. Scope 1, 2, and 3. Now, this is very much heavily weighted towards Scope 3, but to be honest, for most small businesses, we generally see Scope 3 sitting around 95% on average. Now you'll get some businesses that will have more, some less, but generally, Scope 3 dominates. The supply chain emissions is what dominates most of the business's emissions. And within an end report, you'll really be able to understand where the hotspots are. So what were the months that had the most emissions? If it, most likely for a lot of businesses, it might be during winter months where you might be using a lot of the heating in the office. And then you can even see within the categories where the most emissions come from. So purchased goods and services is your supply chain. And we can see here paper might be one for a particular office where that carries the most emissions. So this is a kind of reporting that once your accountant can do this for you and be able to pull this together, you can really start advising about some strategies that you can employ to reduce those emissions. We're big believers in measuring first and really understanding what current state looks like. And then once you know what current state looks like, you know where to focus your attention to reduce your emissions. And of course, it's more than just, being able to measure emissions and reduce them. It's also the story that you as a business can tell within your own community, the suppliers that you choose from, the decisions that you make. No doubt this is, all helping us as a society move forward in the right direction. So it can definitely be something you include within your own brand and marketing if you're putting in the effort. Fantastic. Well, like I said, I want to keep it short and sharp and not bore everyone with too much detail. So that's a high level of the Someday platform. You can always check us out as well if you want to see a bit more in action. Thank you.
Excellent. Cheers, Brad. So that takes us nicely on to Q&A, and at the moment we have no questions. So I can either imagine you're all stunned into silence or we've answered all of your questions. So I'll take one of those. But if nobody has a question, then please feel free to follow up afterwards. Reach out to our VFO team here at PEM, and we will be happy to answer any questions that you have off the back of this webinar, or if you're interested in talking to us about moving forward with your carbon accounting, then we're very happy to talk to you about that. Oh, I think a question just popped up.
Will clients have access to the Someday portal too? I think was that question.
Where did it go?
Yeah. From Catherine, thank you.
Yeah, I think Brad, that's kind of one for either of us really, but I think a typical scenario is if you want to, you can, but it's entirely up to you. I suppose, there are parallels with the normal virtual finance office work that we do, in that some clients are super interested to see how it works behind the scenes and want to have some overview of that. And sometimes people say, I don't understand this, please take care of it for us, and I'll just see the output at the end. So either is fine. Is that fair, Brad?
Yeah, nothing else to add there. That's nail on the head. We see a real mix. And again, parallel to how you might, if you use Xero to run your business, you might be in there often, or you might just say to your accountant, no, you can do it all, and I'll kind of just review the outputs.
As I say, unless anyone has any other questions, I'd just like to thank our speakers today, Amy and Prad. Thanks for contributing. It's been really helpful. We've published some great carbon accounting articles on our PEM website in the last few weeks. I think they've also hit LinkedIn as well and usual channels. So make sure you check those out. Some interesting insights there, both to sort of the local area in Cambridge and beyond. And otherwise, yeah, get in touch and we'll be happy to continue the conversation.
Thank you, everyone.
Excellent.
Cheers, everybody. Thank you.